Hey everyone, I'm going to bring you 3 ridiculously cheap stocks you can buy hand over fist now. And as usually is the case with cheap stocks, there's usually a reason why they're cheap. Stocks don't become cheap just by accident. So I'll discuss why they're cheap and why I think it's still a buy despite the reasons for the cheap valuation. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, the first ridiculously cheap stock I'm going to recommend as a buy is Alibaba, which is trading at a forward price to earnings of 8.6. Now, the primary reason why Alibaba stock is cheap is because of the decelerating revenue growth. It's had a hard time growing its cash flow, growing earnings, growing revenue in the last 2 to 3 years. And management acknowledges that, saying that their top priority right now is to reignite the growth of the business. They're going to step up investment to try and spur growth in the business. I think Alibaba is going to have reasonable success in reigniting growth as the Chinese economy is demonstrating better growth in the last couple of months. Exports are starting to rebound. Consumer behavior is working more in favor of the Chinese economy worldwide as people are now pulling back on spending money away from home. Remember, for a couple of years, we were just unleashing this pent-up demand to get out of the house, go to restaurants, bars, theme parks, concerts, etc., travel. But now that prices have absolutely soared for those experiences, just look at restaurant prices, how much it costs to eat out versus how much it used to cost in 2019, how much it costs to travel versus how much it used to cost in 2019. People have now seen this and said, all right, enough is enough. We got it out of our system and we're starting to pull back, and you can see that with several results from these away from home type companies like Expedia. We saw declining results. McDonald's, we saw declining results. Starbucks, we saw declining results. And we're noticing people are starting to pull back and say, you know what, these away from home things, they're just getting too expensive now. That's going to benefit the Chinese economy. The exports are focused more on a goods-based economy. And then if the Chinese economy is doing well, that's going to be a positive tailwind for Alibaba, as well as these initiatives to reignite growth. Now, investors and analysts that are following Alibaba stock, they're not too bullish on the estimates. For the next 5 years, the analysts that are following Alibaba stock, they think it's only going to grow earnings per share at 1.4%. I estimate it's going to grow at a much faster rate than that, closer to 5% over the next 5 years. So I would say something along the lines of that midpoint, low single digit growth is what you can expect from Alibaba, but it's still a good value considering how cheap you can buy Alibaba stock today. The next stock I'm going to recommend is Fiverr International. Fiverr is trading at a forward price to earnings of just 9. Fiverr is trading at a cheap valuation for 2 primary reasons. Number one being that it is an Israeli-based business, and the war in Israel is not going to be good for a company that's based in Israel. Number two, the company operates a gig economy platform where it brings together those that are offering digital services and those that are buying digital services, things that you do remotely. That is under threat by the rising effectiveness of artificial intelligence. Investors are worried that AI is going to take away the need for businesses to go to Fiverr and hire people for these types of jobs. Management says they don't think that's the case. They think that, yes, some jobs are going to be hurt by AI, but they also think that an equal number, if not greater number, of jobs are going to be created because of AI, people using AI to help businesses. And I tend to agree with the latter. I think that AI is going to be disruptive for business, to be sure, but I think it's going to create an equal number, if not greater number, of jobs overall. And I think Fiverr will benefit from that trend in the long term. So at a forward PE of 9, I think it's a bargain value, especially because Fiverr has done an incredible job boosting profitability and cash flow from operations. You can see the growth there. $83 million in cash flow from operations in the most recent trailing 12-month period, up from negative $50 million in 2019. Furthermore, the analysts that are following Fiverr International stock on Wall Street, they think it's going to grow earnings per share at 123% over the next 5 years. Now, that growth rate might be optimistic, might be too optimistic, but considering that in the past 5 years, it has grown earnings per share at 59.86%, even if you forecast, okay, it's not going to do 123, it's only going to do what it's done in the last 5 years, that still makes a bargain of a stock. If it grows its earnings per share at 59% over the next 5 years, investors in Fiverr stock are going to become wealthier than they are today. That's inevitable if the company increases its earnings per share by that magnitude. I shouldn't say inevitable. I should say it's highly likely that if earnings per share grow at 60% for 5 years, it's highly likely that Fiverr's stock price is going to be much higher 5 years from now than it is today. And last but not least, PayPal is an incredibly cheap stock trading at a forward price to earnings of just 13.84. The reasons why PayPal stock has become cheap are twofold. Number one, competition is increasing it in the industry, making it less likely that people will use PayPal or PayPal's services when they are checking out, when they are making payments. And number two, PayPal had been experiencing millions and millions of customers leaving the company. Active users were becoming inactive users for 5 consecutive quarters, but in the most recent quarter, that trend ended and that trend reversed. PayPal actually added millions of millions of active users that re-engaged with the platform. So that was great news. It ended that terrible streak. PayPal's cash flow from operations has been flat. Relatively little growth in the last 5 years, 5.59 billion in the trailing 12-month period. So struggling to get cash flow up and increasing. Management forecasting free cash flow of 5 billion for 2024. But given their first quarterly results, they're ahead of schedule. They're actually on pace to exceed 6 billion in cash flow in 2024 if the rest of the year goes along the lines of how its first quarter went. So even though it hasn't done really well in cash flow from operations, 5-6 billion is still a lot in cash flow. The company has used that to buy back its stock, and they plan to do so again this year. Finally, analysts on Wall Street that are following PayPal stock, they think it's going to grow earnings per share at 15.93% over the next 5 years, and that's above its valuation multiple of 13.84. Typically, when you see that the growth rate in earnings per share higher than the forward PE multiple, you're getting a good value in that investment, and I believe that to be the case here with PayPal. So there you have it, 3 ridiculously cheap stocks that I think investors can buy hand over fist today. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.